Welcome to the Compass series of conversations with leaders charting the course in impact investing. I'm Ben Thornley, and thank you for joining us. Today's session will be co-moderated by my colleague Jade Huynh, and it's the second of a two-part Compass series conversation focused on the significant opportunity for compelling financial and impact returns in fixed income. Fixed income is the largest of all asset classes, and for allocators, a critical portfolio anchor. Today, we will explore the way impact investors are approaching fixed income, while also diving into the opportunity to significantly scale the market and with it, impact investing writ large. The Compass series follows the publication by Tideline, Bluemark, and Builder's Vision of a new report, Scaling Solutions, the Fixed Income Opportunity Hiding in Plain Sight, which we will link in the chat. For those joining us, please feel free to use the Q&A function in Zoom to submit any questions. We will reserve 10 to 15 minutes at the end of the webinar for panelists' responses. Now, to get us started, I'd like to invite Jade to share some select insights from our new report. And my question for you, Jade, is, what are the key takeaways you'd want allocators and market builders specifically to be aware of?
Thanks for the question, Ben. So in our last Compass series discussion, I and my other panelists shared several takeaways that we think are highly relevant to an allocator and market builder audience. So without being too repetitive, one key takeaway was on the unique roles that fixed income can play within a broader impact toolkit, which we define to be speed, scale, and specificity. Another takeaway is that you don't need to reinvent the wheel to seize impact fixed income opportunities now, as existing standards, frameworks, and best practices, like the operating principles for impact management and the various frameworks arising from the GIN and impact frontiers, translate very well to this asset class. We firmly believe that allocators can dive in and begin seizing opportunities now, and we provide them with a whole roadmap in the report to support them in doing so. But before starting, they should bear in mind in the next slide that there are distinct ways that impact shows up in fixed income relative to asset classes that are more familiar to impact investors, such as private equity. We touched on this a bit in our last discussion, but to be more specific, I have here a core table from Scaling Solutions, which explores how the pillars of impact investing as defined by the GIN, as intentionality, contribution, and measurement show up in this asset class. Now there's a lot here, and rest assured there's no test at the end of this webinar to remember everything. And of course, it's explored in depth in the report itself. But what you should take away from this is that there are clear guideposts for how to navigate fixed income as part of a broader portfolio. So for example, in comparison to, for example, private market strategies, allocators should expect impact fixed income managers to define broader, more inclusive strategies when assessing intentionality. They should expect contribution to be an area where practices significantly diverge in this asset class relative to others. So whereas contribution is usually thought of as occurring during the holding period, as per private equity, in fixed income, contribution activities typically happen prior to purchase. And lastly, on impact measurement, allocators can expect this to be a place where fixed income really shines relative to other asset classes because of the nature of how fixed income instruments are structured. The point here is that allocators should really view fixed income as a familiar and approachable asset class, but also one that has distinctive features that require thoughtful navigation in the context of a broader portfolio. One also important and slightly less text-dense framework from the report that we didn't cover in our last discussion is the taxonomy for sustainable fixed income strategies, which we created to support investors in comparing between products and assessing integrity. The taxonomy defines three core approaches within the fixed income market: responsibility-focused approaches, where securities are selected based on issuers' commitment to responsible business practices; impact-aligned approaches, where securities are selected based on their contribution to broad impact challenges; and impact-centered approaches, where securities are selected based on their alignment to an investor's specifically defined impact strategy. While we obviously see value in this framework, some skeptics might ask, why do we need another taxonomy in a market that is already distinguished by a robust labeling regime? And the answer is that the taxonomy's purpose is not just supporting classification for classification's sake, but instead bridging the divide between the labeled bond and impact investing markets to give impact investors a clearer way to navigate the full universe of impactful opportunities out there. And this is important because, as we'll discuss, the labeled bond market and the impact investing markets have largely developed in parallel, having somewhat separate vocabularies, players, and norms, which can pose some accessibility challenges at first. Moreover, while the labeling regime has brought welcome impact discipline to fixed income, it also comes with some challenges. So, for example, the use of a label on its own doesn't necessarily guarantee high quality or meaningful impact. And there are also other impactful opportunities within this market that aren't covered by the labeling regime, like general purpose bonds. What we ultimately want allocators and market builders to take away from this taxonomy and the report more broadly in closing is that creating crosswalks between the labeled bond market and the broader impact investing market is essential to addressing today's most pressing challenges at scale. And in doing so, we hope to foster shared understanding, mobilize greater capital, and reinforce impact integrity in the growing impact fixed income market.
Well, thanks, Jay. That was an excellent overview. And it's my great privilege now to introduce our four panelists to discuss what you've just shared, each of whom brings a unique perspective, I think, that will help us get to the bottom of how we move forward and impact fixed income. Um, Ina Hoxha is the Chief Investment Officer and Deputy CEO at Climate Bonds Initiative, the leading NGO driving the growth of the green and sustainable debt market. Ina's wealth of experience in mobilizing and blending capital has included roles with the World Bank, Macquarie Group, and the Danish DFI, IFU. Welcome, Ina. Roraj Pradhananga is a partner and chief investment officer at Veris Wealth Partners, which for almost 30 years now has been one of the most prominent financial advisory firms focused on sustainable and impact investing. Roraj has over 17 years of experience across wealth management, asset management, banking, and insurance, including working with Robeco, Citigroup, and KPMG prior to Veris. Welcome, Roraj. Juhi Rand is the head of Secretariat and Director for the Impact Principles, the global standard for integrating impact throughout the investment lifecycle, hosted by the GIN. I'm very proud to say that Juhi's 2 decades of experience working across impact investing, philanthropy, and global management consulting included an important chapter at Tideline. She's also a McKinsey alum. Welcome, Juhi. Danielle Reed is Managing Director on the investment team at Builders Vision, one of the most important single-family office and foundation investors in our market. Danielle has a long history as a leading allocator in impact. She was the head of ESG and impact investing for Jordan Park, a member of the sustainability and impact team at Cambridge Associates, and worked at Imprint Capital prior to its acquisition by Goldman Sachs. Welcome, Danielle. And thank you all for joining us. And thank you for your important work and leadership in impact. Roraj, I'd like to start with you. What are your views on the importance and utility of impact fixed income within your clients' portfolios, and how have you approached the asset class as an impact opportunity?
Thank you, Ben, and thank you, Tideline, for having me here. So Veris is an impact investment advisory firm, and we work with mission and values aligned clients consisting of high net worth individuals, families, family offices, foundation endowments. At Veris, we believe that investors can have impact across asset classes, fixed income being one of them. And allocating to impact fixed income is aligning with our clients' mission and values in their portfolios and as fiduciaries on our part, and meeting the dual mandate of generating both financial returns and impact outcomes. Now, we allocate to fixed income for various purposes, like many allocators, from diversification, lower volatility, with the aim of capital preservation, risk management, liquidity yield, and generating risk-adjusted returns compared to the benchmark. But besides that, we believe that integration of financially material, environmental, social, or governance factors in the investment process can have material impact on these investments. Integrating these factors not only help mitigate risk, but also helps us uncover meaningful opportunities for both financial gains and impact outcomes. While integrating, ESG factors is important in investment decision making in terms of our allocation, we also identify strategies that have very intentional impact objectives. by assessing how they're intentionally creating positive impact by allocating to certain securities, issuers, or projects, and that they're tracking and reporting these outcomes. So impact measurement and management becomes key in that process. And the way we do this is by allocating to management strategies that are actively investing in various thematic areas. So just to name a few that where our clients are really interested in, really around environmental sustainability, particularly around the topics of net zero, climate resiliency and adaptation, renewable energy, natural resources, etc. On the social side, a lot of focus around gender lens, racial justice, affordable housing, community development, and worker rights. So we are identifying management strategies that take a thematic approach to investing by identifying securities that align with various themes that I mentioned. Um, Furthermore, we also then have conversation with these management strategies around sub-asset class. So for example, we do not see treasuries as an impact vehicle. So in many of our separately managed accounts for our clients, how can we get exposure, similar exposure through supranationals like World Bank or Inter-American Development Bank or ADB, for example. In the case of corporate and label bonds, really looking at user proceeds, looking at the issuer's business models, their products and services in terms of alignment with those themes. Where we also see a lot of allocation and interest within our client base around munis, both tax-free as well as taxable munis. And there, if you really look at the underlying sectors, whether it's hospitals or education or utilities, they're fully aligned with our clients' impact focus. We also use munis as a place-based investment approach for our clients. We get a lot of clients, especially foundations and some family offices who have a place-based approach, and we're really focusing on certain geographies and states, for example, for them. We also work with asset managers, who have mutual fund products or ETFs, and there we're also, looking at exposure around mortgage-backed, residential mortgage-backed securities, commercial mortgage-backed securities, where our managers are really looking at underlying mortgage pools in low and moderate income communities, in high poverty census tracts, where they're providing liquidity for creation of affordable housing, workforce housing, or home ownership. Another sub-asset class that we look at, and we have a lot of community development financial institutions approved on our platform. We directly invest in their notes, but a lot of CDFIs, especially particularly the larger CDFIs, are also issuing bonds now. And the last few years, we've spent a lot of time engaging with our managers around allocation to CDFI bonds. A lot of our managers, they're still managing yield, duration, credit quality, sector exposure for us. But at the same time, they're also making sure that the outcomes, especially positive environmental and social outcomes, are at the forefront of these allocations. So like I mentioned earlier, impact measurement and management becomes very important. And we usually have engagement with our managers around what can they provide in terms of quantitative as well as qualitative data. Storytelling becomes very important for our clients. So a lot of opportunities here, Ben, in terms of impact fixed income in client portfolios and how we think about allocating them across our client portfolios.
Well, thank you, Roraj. That's a super optimistic view on I think the breadth and the opportunity within fixed income. So thank you for sharing that even more than I might have expected. But thank you for that. Danielle, turning to you. As a market building organization, obviously Build has partnered with Tideline and Bluemark on this research, which we deeply appreciated, but you also play an important role as an investor in your own right. So how are you approaching impact fixed income at Builders, and sort of how were you approaching it both before we completed the research and as a result of the research, how are you now thinking about impact fixed income?
Yeah, happy to cover that. And thank you, our host, for having us and bringing us together. I really appreciate it. I would echo a lot of what Roraj said in his discussion, and we use a lot of the same strategies and tools as they provide to their various clients. We are a single family office, but we have a plethora of portfolios here and two that I think are helpful to mention because they might resonate with some of those listening. We have a taxable portfolio that has a very important financial objective. It is the financial engine of our firm. So we take very seriously the role of fixed income in that portfolio, but we also want to drive as much impact as we can into that portfolio. So it is a balancing act, like many of you may be facing. We also have a foundation that has an endowment. Ben mentioned this, and that has a different mandate, right? It's meant to support our grant making. It has a higher spend requirement. It is also very impact oriented. And in fact, our goal is to reach 100% ESG and impact in that portfolio. That's an explicit target that's different than some of our other portfolios. We're at 97% there. There's one last EM ETF that we're hoping to find a suitable replacement for, but really driving hard towards that impact. And that can look a lot of different ways. So as Roraj mentioned, we look for things that maybe integrate ESG factors into sort of the risk analysis for some of our fixed income in those portfolios, but all the way to the other end of the spectrum in terms of some more innovative climate-oriented bonds that we've invested in. So I think our anchor around fixed income is that we treat it with the appropriate tax implications, that it serves us in terms of the liquidity that we might need for any of our portfolios, and that it really is sort of the ballast for, when tough times come, we want it to zig when other things are zagging. So I think a lot of these aspects are what all allocators want from their bond portfolio. We have the added goal of trying to drive as much impact in different forms into our portfolios. I think what the research really helped us do is a couple of things. One is to have a sort of not universal, but a framework that we can apply looking back on a lot of our due diligence. So for a lot of the strategies that we underwrote for our fixed income, we approached them different ways. And I think that was appropriate at the time, but this has allowed us to sort of take stock. Okay, why did we underwrite it that way? Let's try to use a more consistent framework, a more consistent way of underwriting these various strategies so that we really understand where were we leaning into, ESG for risk reasons? Where were we really leaning into use of proceeds as kind of the driving force behind impact? Where were we leaning into a place-based strategy? We do have some Chicago area place-based fixed income products that are supporting the place where we are headquartered. So, we had these kind of disparate reasons for investing in these strategies, but this research has allowed us to apply a more consistent framework to really look back and see, are those strategies serving us in the ways that we hoped? And importantly, where can we add new strategies, maybe that we didn't identify before that exist in the marketplace that would fit in and start to fill in a little bit more of that spectrum. I think we had kind of a barbell effect going on, and I think we want to see more of a consistent application of impactful fixed income more across the spectrum, and that's maybe our goal for the future.
Great. Well, thanks, Danielle. I look forward to coming back to both you and Roraj and asking the question, what is the particular role that builders can play as an investor with a little more flexibility in some of those portfolios to kind of catalyze the growth of the market. So we'll come back to that. But thank you. Juhi, why do you think that impact fixed income or fixed income generally hasn't received as much attention within the impact investing market? And to the extent that it has, what has been your experience and your signatories' experience of aligning fixed income related practices with the requirements of the impact principles?
Thanks, Ben, for the question and for having me on the panel. And congratulations to Tideline, Bluemark, and the Builders Vision team for this really timely and much needed knowledge contribution to the field. So thanks for that. Let me actually start with the second part of your question, Ben. I appreciated seeing one of the report's conclusions that the core principles of impact investing can help investors rapidly scale allocations to impact fixed income with confidence. And that's very consistent with the design of the impact principles to be universally applicable with flexibility across all asset classes, investor types, and impact themes as the global standard for impact management practice. So fixed income is smaller now, but growing pretty rapidly as an asset class among our signatory base, and represents about 10% of over 180 signatories today around the world. What's notable is the diversity in the type of investors in fixed income amongst the signatory base. So it really ranges from impact specialist asset managers to large diversified financial institutions, as well as asset owners like insurance and DFIs and MDBs. Some came from a long history in private equity or private debt and are now launching public debt strategies, and others entered impact investing through fixed income by investing or issuing green, social, and sustainability bonds. So we are seeing that fixed income really serves both as an entry point for new impact investors and scaling strategy for experienced ones. We also see a wide range of approaches from place-based strategies in emerging and developed markets and project and transition finance, social impact bonds, corporate municipal, sovereign debt, all the products that you mentioned in your report. In terms of practice, what we see is that OPIM is highly adaptable to fixed income, again, consistent with what your report found. Contribution strategies may look a little different, but they're still very meaningful. So some signatories engage with issuers upfront to improve the bond's impact frameworks and their impact practices, mitigate sustainability risks, or address underperformance, actually, too. Others play a market building role if they are impact leaders in the field already by helping shape the industry standards like green and social bond principles, or actually anchor new issuances in underserved markets to signal demand. So we are seeing all these practices in their disclosure statements. So going back to your first question, why hasn't fixed income received as much attention within the impact investing field? I can try to name two reasons. First, I think there's been a narrow perception of what impact investing needs to look like in the market. The field grew up in private markets where impact investments take longer to identify and deploy, strategies are more focused, and investors have hands-on engagement and influence and tend to stay invested for longer-term horizons. So against that backdrop, fixed income with liquidity, diversification, speed of allocation, and flexibility, as well as specificity, can feel almost too easy to be impact and can actually cause skepticism. But I agree that those very characteristics, I think you named them, speed, scale, and specificity, are precisely what make fixed income a potentially transformative impact investing asset class if it is managed with discipline and transparency. So second, I think it reflects the natural sequencing of the market maturity. So private markets seeded the solutions, they built the track records, and established impact management frameworks that are in the market now. Now those proven practices can be tested, adapted, and applied in public markets to mainstream and scale solutions. So fixed income may have been under the radar until recently, but maybe that's not a bad thing. As an industry, we now have clearer standards and discipline for impact management in place, and also more readiness and pipeline of market solutions that can be scaled in public markets. So I would say now is the moment. And it's great that we have proven standards and frameworks and managers and allocators that are investing in this asset class with impact integrity and discipline, including those featured in your case studies and many of our OPIM signatories. Maybe I'll stop there.
Great. Well, thank you, Juhi. Really, that's an inspiring call to action, and I think really nice summary of where we're at and the opportunity I think that is ahead of us. So thank you for those comments, Juhi. Ina, turning to you, I mean, I'm curious generally to what extent Climate Bond Initiative interacts with investors you would consider impact investors, but I think above and beyond that, to Jade's earlier point, there seems to have been a disconnect between the impact investing and the labeled bond markets, and just curious if in your view it's time to build bridges, and perhaps some of the ways we could build bridges between those worlds that feel a little different.
Yeah, thank you. So, I mean, I am one of those very weird people that has spent most of my life in the sort of equities and Macquarie and then within equities and impact equity. So having joined the sort of the bond universe, and Climate Bonds has a membership network of 182 institutional investors, so mostly pension funds and insurance companies that cumulatively have $30 trillion. So when I moved, my first sort of day on the job, I said, okay, well, I come from this other world. I'm interested, and sometimes I spoke to the same members, right, that I had previously raised equity funds for, but usually different teams. And I think the first question that, I would ask, I said, well, why is this so different? I think, everybody would sort of say, well, I mean, first of all, the way that the bond market has been built is that labels price the bonds. So the use of proceeds labels that also climate bonds has, initiated in the market, they certify security, one bond, and then the fund manager often aggregates these many different securities, but it isn't a strategy. Whereas when you were at Macquarie, Ina, we used to, fund Macquarie's, that particular fund, infrastructure, emerging markets, impact, that was a strategy. And that is quite different, which actually I think goes to the point of your report, which is also why I was very excited that, you helped me make that connection as well, which is, I think moving from a sort of like labels and aggregation of labels is different to sort of backing particular fund manager strategies. And I think, the people at the top of the sort of food chain, institutional investors, when they look at equity, or impact and equity, they look at, strategies of that fund manager, and whereas it seems that in the bond market, they just see, there's a collection of labels. And there's a reason for that. They're not dumb. I mean, they're not uncaring, maybe, I think, first of all, as everybody said, I think there is maybe a distinction we need to make between impact investors, so family offices, foundations, or that have very much a return, sort of priority, but to still think in terms of that long term, and institutional investors like pension funds and insurance companies that think, well, especially within the debt departments of those teams, they think, well, we already have every kind of allocation we do to the bond market, we actually have to kind of align with an index, and any deviation from an index, I mean, just basically means less liquidity, much more error tracking. It makes it difficult to justify it. And as they reminded me over and over, they're not an impact investor. I mean, pension funds that we represent are first and foremost defined, most of them, their sort of duty of care to returning the capital. And if there is impact, great. So in that sense, I also understand why even the labels, which again, we started and I think definitely need to improve. So, this is also why I'm so keen to be in this debate. So I don't think that we should leave the fixed income market at the labels level, but there is an issue in the current plumbing of that, of the bond market, that makes it quite difficult unless there's an actual explicit allocation of a portfolio that is allowed to kind of deviate maybe 50, 100 bips from that index allocator. So I'd say the third and last reason why there is a disconnect is, and I think it's been mentioned by other people, but just to make it very clear, is that in the bond market, the impact most of the time is done only upfront, pre-issuance. There's a little bit of kind of discussions after, but you only have control at pre-issuance when there's just a lot of plans potentially, or if it's secondary, there is refinancing. But I think in the equity markets, there's just a very clear control of not only before you invest in a fund manager or in a project or in an asset, and then the fact that you sit on the board is absolutely crucial, and it actually does impact not only how a fund manager or a company actually does impact. And I think that is a very, very important deviation, and I don't think we should shy away from the fact that it is quite different.
Yeah, really appreciate that, Ina. And just to repeat what you'd said, and I think we can come back to this in the questions, and I'd be interested, Danielle, Roraj, in your reactions once we come to this part of the conversation. But yeah, the focus at an issuer rather than a fund or manager level,
Yes.
the importance of hewing closely to indexes, and then of course the opportunity to influence, which is a little more constrained and upfront, which too he had mentioned, and Jade as well. But really important points, Ina, and we appreciate you making them. Okay, I'm going to turn it over to Jade to take us through our next round of questions, but thank you.
Thanks, Ben. So we're going to continue on with the optimistic drumbeat and the second set of questions for our panelists on the future of the impact investing market and how we may imagine continuing to build bridges between impact investing and impact fixed income. So my first question is for Danielle. What is Builder's thesis on how the impact fixed income market should grow? And in your eyes, what needs to happen next, and what outcomes can we expect should more impact investing capital find its way to impact fixed income?
Yeah, it's a good set of questions, and I think there's things that we have expectations or hopes around for maybe the shorter term, and then some more grandiose ambitions for the longer term, and we'll see how those all play out. But I think our hope with some of this research is to really provide new thinking to all types of allocators, whether you are more of a need to resemble the index type of allocator because that's your mandate or that's the type of organization that you are, or you can take a little more risk like we can, admittedly, on the impact front. That there is at least components of these frameworks and principles that will help you better understand your portfolio today and help you identify, opportunities or new risk frameworks that might help you with your portfolio. So, the point being, almost every allocator holds bonds of some kind. And so hopefully there are aspects of this research that help you better understand how to operate with those parts of your portfolios. It could be good, I think, as Juhi said, a good entry point for those that might not be thinking, oh, my fixed income, it serves me well today. Why mess with it? It's meant to be this risk mitigating part of my portfolio. Let's just leave it at that. But my view is, and I think Builders Vision's view is that all parts of your portfolio should work hard for you. And if you have an impact interest or an impact mandate, that you should at least take stock of what you've got and understand what you might activate going forward. I think that's kind of our highest level theory of change around what we hope to see in terms of impactful fixed income. I think we talked a lot in leading up to this in terms of like, is this report meant more for managers or more for allocators? And I think it is both equally. And so I think what I also hope to see is for fixed income platforms that maybe don't have a lot of strategies around impact today or have no impact strategies that they offer today, that they understand more about what impact investors might be looking for. I honestly think that's a big impediment to managers that are like, I sort of see the business opportunity, but that group of people seems like a big pain. I don't really want to figure out what they're looking for in their due diligence. The top 3 questions I get during due diligence with the manager, one of them is, what do you need from me? I don't understand what you're looking for. What information can I provide for you? What can I put in my data room? So I think to have research out there that is aligning both sides of the table more clearly, more efficiently, more effectively, I hope will help bring more allocators to the table with an interest and that they go out and ask their fixed income platforms for more impactful strategies. And likewise, that bond managers better understand what in the world impact investors are looking for. What are our IMM expectations? All those sorts of things. They're fair questions. And so I think putting more research out in the world that helps bring both sides of the table with more confidence and more effectiveness, I think is important to kind of the growth of this part of the investable universe.
Thanks, Danielle. I'm going to turn to Roraj now. So what do you see as the opportunities and the challenges in bringing more allocators' attention to impact fixed income? And is there a role for more catalytic investors to play in growing this market?
Thank you, Jade. Yeah, so definitely I'll start with the second question. And catalytic investors have a huge role to play here in furthering and developing this market through their allocation. I'll start by saying, like, if you're an asset owner, you should be asking your your advisors and your asset managers about impact fixed income opportunities. If you're an asset manager, you should be engaging with issuers. And if you are an issuer, you should be really focused on disclosing more around, and more transparency around the impact outcomes. And these are very critical for investors to really understand the impact of these issuances. One way Veris as an allocator thinks about moving the space forward is education and awareness of asset owners and our clients. And I talked about sub-asset classes and thematic areas. How do you have those conversations? When are some of those asset classes appropriate in client portfolios? And same thing from a thematic and impact alignment. I think the best way to do this is particularly around the time of having conversation around investment policy statement development. When we onboard clients, making sure that we are including all stakeholders, whether it's family members or foundation board members or even stakeholders, employees, getting a clear sense of what are some of the impact objectives and financial objectives, making sure that there's clarity as you're documenting these, and we as allocators have a clear understanding of what is expected, and this applies to fixed income as well. right? I think making sure you're having those conversations are important. Now, also as allocators, as advisors here for the investments team at Veris, is really about incorporating the analysis of the impact thesis and outcomes as part of our due diligence process. I think that is very critical. What kinds of questions are you asking of asset managers? Making sure you're doing deep dives of their investment process. Make sure you're doing deep dive of the type of holdings that they will invest in or have invested in. I think the Tideline Builders Vision report focuses mentions 5 dimensions of impact. We use that at Veris to really get an understanding of how a particular holding fits in that portfolio, and also helps us understand what are some of the unintended negative impact of those investments. Are we looking at net positive impact is what we're trying to get at in client portfolios. And now in terms of some of the opportunities, Jay, to answer your question, look, I think impact measurement management is a evolving space. I mean, I think impact reporting can certainly be improved. And while fixed income managers we work with have done a great job in terms of impact reporting, our clients do want impact outcomes, right? I think when we think about metrics, sometimes the outcomes aren't very clear, and this is where some of the storytelling and qualitative examples are very critical. And I think definitely it's getting better, but of course, I think there's some improvement opportunity there. Talked about engaging earlier, especially with issuers. I think at Veris, our theory of change in public markets for both public equities and fixed income is around engagement. And particularly as we look at the pushback around shareholder advocacy, challenges around engagement, challenges around shareholder proposals. If you think about meeting the moment here and being creative, I think bondholder engagement is an opportunity in the space to drive change. And this can be applied across sub-asset classes. While corporates, we can learn from our experience in shareholder advocacy, but engaging with munis, engaging with issuers around securitized products, and Veris, along with various other firms like Community Capital Management, Impacts, Shares Advisory, we're all members of ICCR, Interfaith Center for Corporate Responsibility, have been working on moving forward bondholder engagement. What are some of the best practices out there in terms of engaging with issuers? What kind of data around ESG and impact do we want in our decision making and moving and ensuring that the impacts are very clear, in client portfolios? But also really, thinking outside the box, who do we engage with? And on the shareholder side, there's a lot of engagement with corporates, for example, right? And boards and C-suite and investor relations. Who else can we engage with outside of this space, particularly around underwriters, right, and traders, etc. So I think just being more creative around engagement is a huge opportunity to really think about impact within portfolios from a fixed income perspective.
Awesome. Thank you so much, Roraj. So much to chew on there. We're going to end the series of questions with some targeted questions for Ina and Juhi, where we're going to brainstorm some solutions to bridging the gap between the labeled bonds and impact investing market. So I'll start with Ina. Can you imagine a world in which an impact label helps to strengthen and grow the labeled bonds market? My hope is that your answer is yes, of course. And what would be the benefits of attracting more impact-focused capital to the labeled bonds market?
Thanks so much. So the answer is yes. But I wanted to use a little bit the experience that climate bonds has had with labels to kind of warn for some of the things that we didn't do well or we haven't done well yet. And I think I think those lessons can then now be hopefully learned to kind of have an impact label that is more powerful than the sort of green, social, and sustainability labels that we started. And the key thing there is, again, that this large scale allocators of capital, pension funds and insurance companies, are by their very nature very conservative in general. I think you also mentioned that in your report, so kudos for that. So in that sense, I think what would be super interesting and important, and we did not do it well, and we did it well, but we did it like after 10 years, is that we actually fragmented the market into many different labels. And then we've kind of went back at green and climate bonds. We had an adaptation, resilience, and nature bond, a social sustainability bond labels. And actually now we've come back and said, no, everything is a green label, but within that green label, there will be different types of use of proceeds or sustainability linked, and the KPIs will be different, but the label is green. There's just different use of proceeds. So you could think of it almost like a cake with different layers, and some of it might be, transition or net zero. Some of it, will be adaptation and resilience. Some of it might even be social within the same bond. And I think that has created a massive amount of liquidity. So even though we care a lot about impact, which is what we do, I think we need to think about ultimately these labels, which are initially going to be innovative, scary, etc. How do we already build them up front for where we want them to go, which is build them for scale? And I think that is the lesson that we learned. So yes, I think it's very absolutely possible, and I will go into the how, but I think it's sort of just as a sort of kind of reframing of impact cannot just sit there. Impact labels cannot just, as amazing as impact investors like family offices, foundations, and they do have a lot of assets under. I think where we really want that to go is to go to to use this sort of de-risking like builders to kind of create the labels initially at scale, but then already build characteristics of these labels, the impact label for who ultimately we want to kind of scale this up in the trillions. And just to give you one example, the current bond market is about $150 trillion, and the labeled market is about 12 trillion, of which we have certified or verified only 6 trillion. It's tiny, and we've been at it for 15 years. And I think it was only when we started to kind of not fragment and put everything into the same sort of cake with just one label green, did that liquidity start to really hit the trillions. So that's the big thing. But I think very briefly on the how, I think, again, and kudos to you for coming up with this framework, I think we need to kind of move from labels and the portfolio and aggregation of labels to this sort of, doing strategy taxonomies. I think the second one is to hardwire integrity where it's most debated. So even for sustainability linked bonds, which I think is an amazing impact instrument, we need to insist on material step-ups, ambitious KPIs, and third-party assurances. I think there was a period where sustainability linked bonds were just very weakly structured. I think we need to make the primary market the impact moment, and I think this is also a point you made, so I'm just reiterating, but it's a very important one, and we need to do the first issuances at big scale, so they already kind of create the liquidity that is currently being, that it will not have because it's a new label. And then I think, I made that point before, which is I think we need to be benchmark aware and not benchmark bound, and this is so key, because I think, again, we want to build for scale. So we want to kind of create this risk taking impact investors, such as builders and Veritas and others, to actually create sleeves with explicit tracking error budgets. And just make it very explicit. There will be a track error budget, 50 bips, 100 bips, and we need to use custom indices and overlays and neutralize duration with derivatives, and so managers can source impact paper without blowing these risk limits. Otherwise, it will always stay a very small market. And I think in the bond market, the bigger the size, the more liquidity, the more pricing thing. And then I think the last bit is I think we can report like an impact investor, but we need to aggregate like a bond manager. And I think that's the bridge that we're kind of missing currently, that we maybe are aggregating like bond managers, but I think we need to also kind of bring in a little bit more kind of granularity, which impact investors have had, which is portfolio level matrices and consistent, I would say, standards, so that all trustees and all fund managers, asset owners can compare managers on impact with the same ease they compare yield or spread. So that standardization is super key. I'll leave it there.
Awesome, Ina. I can tell you've been thinking a lot about this, and thank you so much. I'm going to ask Juhi our final question, which is the converse of what I asked Ina. What steps do you think impact investors need to take to be more accommodating of fixed income as a compelling part of the impact investing market to deepen connectivity with the labeled bonds market?
Thank you, Jade. It's a really interesting and important question. And I think I'm actually hearing some coherent message emerging from this conversation and really learning a lot from everyone. So thank you. The reality is that if we want to truly scale impact investing to meet the global needs, we simply cannot afford to overlook fixed income asset class. As the report makes a strong case, it is the largest asset class globally, and it offers one of the fastest pathways to mobilize mainstream capital at scale. But the challenge is to do it with integrity, not by lowering the bar or simply labeling or rebranding existing activity, but crowding in more mainstream capital to be directed to scaling high impact solutions, especially in underserved markets, and hold them accountable for driving impact results, not just reward intentionality indicated in labels. So I would highlight 3 steps to just keep it simple. First, as you mentioned during introduction, don't reinvent the wheel, but adapt them to fixed income. We already have robust, well-established impact frameworks and tools like OPIM, but there's also 5 dimensions of impact and IRIS Plus and other frameworks that investors can align with to demonstrate their impact investing credibility. The key is to apply them thoughtfully to fixed income. So for example, by being more creative about contribution strategies that really leverage unique strengths of fixed income, i.e. speed, scale, and specificity, instead of replicating private market practices that's not fit for purpose. So this may look like anchoring new bond issuances, scaling demand for underserved themes, or engaging with issuers to enhance impact frameworks, as we all talked about. Second, I think directly to your question, to build connectivity between labeled bonds market and impact investing, we need more impact-centered and impact-aligned asset managers investing in these bonds and engaging with issuers using best practices in impact management. That includes investor-level strategies and portfolio-level impact management processes and systems beyond just transactions, which the labels tend to be for. And importantly, if we want to incentivize this behavior in the market for managers, we need asset owners and allocators to be able to assess and discern the impact credibility of the managers in fixed income, not just from a label or impact claim, but from the manager's impact strategies, systems, and processes and track record. And we don't want this to be a bespoke approach and bespoke due diligence that proliferates fragmentation in the market. We need converging around standards for common language, shared expectations on best practices, and impact accountability that will help create efficiencies and greater confidence in the market. Lastly, I think some of us mentioned this, but I want to highlight and not overlook the importance of activating catalytic capital and capacity building as we try to scale impact fixed income in the market. If we only chase scale and efficiency of fixed income, we risk having unintended consequences and leaving out the very projects and underserved communities with the biggest financing gap, because they are not going to be ready to capitalize on the opportunities for fixed income capital right away. So there's a huge role for impact first and impact centered asset managers and asset owners here for their contribution strategies in a really significant way. They can help build capacity of issuers, de-risk transactions or funds with guarantees, and build really the pipeline of bonds and securitized portfolio from underserved markets so that we can create better market conditions to crowd in mainstream capital towards where it's needed the most. This is going to mean closer collaboration with private market actors like the CDFIs and emerging market managers to prepare those projects and transactions for fixed income capital, and also more cross-sector collaboration between public, philanthropic, and private sectors to really fully harness the potential for fixed income asset class in driving not just capital at scale, but impact at scale.
Well, thank you, Juhi, and thanks to our whole panel. I mean, I've just found these comments to be extraordinary. I feel like we could bottle this up and put it out there as a roadmap for how to grow this market. I mean, really have appreciated all of the phenomenal ideas that you've all contributed. So thank you for that. I think we have had some questions come in, and we're going to run through them and just take the next 10 minutes to respond. And I think there's a kind of category of questions that relate to the difference, Ina and Jade, you both highlighted, of the market being primarily issuer centered in the labeled bond markets versus an impact more manager and fund centered. I might let Jade explore that a little bit more. I wanted to take a slightly different approach to that and tackle one of the other questions, which just relates to something we often hear in impact, which is how do we start with the problem and then figure out that fixed income is the right solution? I think for us, as we researched the report, I think one of the breakthroughs was realizing we needed to make the case for fixed income as an impact solution through speed, scale, and specificity. And I think, Ina, I was going to ask you, I know that's a big part of what Climate Bonds Initiative does. You're interacting with governments and companies and others to try to grow the market, convince folks to issue more labeled bonds. So I'm just curious, how do you start with the problem, the need, and then build a market? Like, what is that part of what you're doing?
Well, thanks, Ben. I mean, and I think I love it also because I think Johi and I looked at the question, we came at it from different angles because I think I want to highlight, because I think it's an interesting conversation and that will answer your question, which is that in some ways we always start with who buys. And I know this isn't, necessarily the right way from an impact perspective. So I agree with Johi completely, I think, and I think she and I would come at it at a different angle. But it is in some ways, again, the problem we are asking, the question we're asking ourselves, and maybe it's a different question, is how do we scale impact? And it doesn't necessarily, I agree that there is a trade-off to that, even in emerging markets where we work a lot. So we have offices in Brazil, in Mexico, in China, Japan, India, anyways, and in all of those countries where we do work with issuers, whether they're sovereigns, corporates, or even financial or banks, financial institutions, I mean, the question people always ask us is, well, will there be investors interested? And is the transactional cost of adding these additional steps worth it? I mean, the government, of Gujarat in the state of Gujarat in India, we've been supporting with issuing a bond. And they said, well, why? I mean, why can't we just issue a vanilla bond? Why are you making this so difficult for me? I mean, why do I need to have KPIs? I can just issue a vanilla bond and still do all the right things. And I said, well, it matters to label things. It matters to say that this is, what you're going to do, that you're going to screen the investments, your public pipeline of EV and infrastructure and renewable energies, etc., for net zero, because there are a lot more investors. So I was trying to argue that sort of diversification of investors will create scale, will create competition, and that competition is going to lower the cost of capital. So we have to go to the question of why would somebody as an issuer go through the trouble, and it is additional transactional cost, and it is new things they often haven't done before. They have most of the time issued, vanilla bonds. Why would they go and issue a green bond or an impact labeled bond? And I think we need to make that connection a lot more for us, for market making ability. We need to make that connection between this isn't just impact, although that is ultimately what we're after, but this is actually, it's going to impact your cost of capital. By having more resilient investments, credit ratings are going to look at you differently. It's going to have impact in cost of capital. So if we can make impact investable, I think we are actually, I think then we're going to get very far.
Thank you. Thank you. Jade?
Sure. I'm going to go back to Ben's question. So a bunch of folks in the Q&A had asked questions regarding engagement with issuers, and of course, we've touched on that a little bit. How would folks on this call leverage sort of bondholder influence to engage with issuers, just knowing that the type of influence is slightly different relative to other asset classes?
I can kick us off here. I mean, look, clearly there are lots of regulatory limitations. You don't have the same legal rights as a bondholder compared to shareholders. You don't have voting rights, right? You don't have an avenue to influence board decisions through shareholder proposals, etc. But at the same time, you do have certain levers, right? I mean, as an investor, particularly, I think the timing of engagement becomes important. If you're engaging with issuers pre-issuance in terms of the type of data and disclosure that you want, indicating as investors what is needed, you have more leverage because you can make a decision whether to invest or not. Of course, post issuance, you can do the same thing as well. You have the decision making of whether you want to continue to remain invested in that issuance or not. You do have some of those levers as investors. But I think, again, the purpose of engagement is, I think the way we think about it is a long-term, engagement approach, relationship building, so that we get to the end goal of better disclosure and transparency. Also, really thinking about timing around, certain business cycles, refinancing, for example, right? Around the times when they're doing some sustainability reporting. There are lots of ways to have influence in terms of engaging. The other thing, I mentioned around was really, who are we engaging with? If, let's say, in the case of corporates, if shareholders are talking to board members, C-suites, and IR about investor relations, about these topics, and bondholders go, talk to CFOs and treasurers of these, same companies, you're hearing from both bondholders and shareholders that these data points are important, right? So I think it's a common thread here across various asset classes that these are important. But also, I think talking to underwriters, whether it's banks, talking to rating agencies, like how are they incorporating that in their rating decision making, right? So I think if they hear from investors across the board, I think we do have influence and can drive change here, despite not having some of the the regulatory, despite having those regulatory limitations.
And if I can add there, I think it also depends on kind of the impact intentionality of the issuers. If we are talking about corporate and other more mainstream issuers without the impact expertise, there's a lot that impact investors can do in helping reinforce, whether it's, we talked about improving impact frameworks, but kind of holding them accountable throughout the processes and really kind of providing that impact expertise. But then there's a lot of kind of impact organizations that don't have the capacity to issue. So being there, hand-holding, even kind of making the case for issuing bonds to this organization so that they can help scale, kind of signaling investability by kind of being the anchor investor in those first issuances. Or I don't know if there's kind of ways to aggregate this kind of issues at the smaller projects from more credible investor perspective. I mean, we hear blended finance is amazing, but scaling is so difficult because it's all bespoke approaches. So the industry coming up ways to scale really impact-driven bond issuances from these markets. I think there's a big opportunity there.
I was just going to add briefly, I agree with all this and was going to say something similar around, leveraging the equity side. If you've invested with a platform that also is buying on the equity side and you're trying to engage some corporate issuers, like we have strategies where they deliberately band together with those portfolio managers to have more of a say. So I was going to echo that. And then also I think in terms of how to actually position the engagement, I think to draw upon what is financially material, rather than not having a clear reason to be engaging that is logical to the issuer, I think, and to be consistent about that. There are bond managers that we work with that they set out a set of themes every year, and they say we're going to ask everyone about these. I think to sort of not make it seem willy-nilly and ad hoc, I think is important for success in terms of these engagement efforts. Great.
Well, thanks, Danielle. And thanks you all. We have a couple of other questions, but I think we're out of time and we'll need to wrap. But some of them are quite specific about blended finance strategies and other targeted strategies. And we may be able to come back to folks who ask those questions with responses. But thank you all for joining us. We love all our Compass series children at Tideline, but I'm going to admit this was one of my favorites. This was an awesome conversation. Really, really appreciated you all joining. I love the combination of all the different perspectives you brought, and feels like it got us to a place with some really fantastic ideas for moving forward. So thank you all so much. Roraj, Danielle, Juhi, really appreciate you joining us. Thank you to those who tuned in. Thanks, Jade. And please visit us at tideline.com. And we will have a recording of this session available in another week or so we can share it with more folks. But thank you, everyone, and we'll see you again soon.